The last video was about the power of starting small and making regular increases to your savings rate. Turned out to be quite a popular video. When I put some numbers on things, I used an assumed annual return of 6%, and I was, as usual, inundated with questions and comments about how to get that kind of return. So, you ask, I answer. Here's how to grow your investments over time. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Build Wealth. More on that in just a little bit. We have to address the big thing first. There is a marked difference between interest and what I called returns in the last video. Now, as I record this in early 2024, the Bank of England base rate is 5.25%, and the best savings rate you can get is about 5.5% on a 90-day notice account. So, in that context, the 6% assumption that I used last time does seem high. But I wasn't talking about interest. I never mentioned that word in that context. I was talking about returns on investments, which is a very different thing. If you save money in the bank, you get interest added. And each year you get a little bit more interest because of compounding. You're getting interest paid on the interest that you've received in previous years. But each pound in the bank will always just be £1. You'll have more of them, of course, but each one will always be £1. Now let's say you invest the same amount of money into shares. Well, they will produce an income, just like the money in the bank, but you can opt for that income to buy more of the shares. Keep doing this for years, and so far, it's the same outcome as the money in the bank. But unlike our pounds in the bank, the value of the stocks and shares will also change over time. Let's say that the price of the stocks that we hold increases by 10%. Then the whole thing gets stretched by that 10%, including the extra stocks that we bought with our income. Of course, the value of shares can also fall, in which case the whole thing gets compressed, and we could even end up with less than we put in. And inflation compresses both interest and investment returns by reducing the buying power of both pots of money. But only the growth from investments makes it possible to beat inflation and grow your money in real terms. So, crucial point. The fact that share prices, and therefore the value of a share's investment, can rise and fall, that is the key to getting the returns that I talked about. And you don't have to be a genius investor to achieve this. Now, if that was a helpful explainer of how investments work versus money in the bank, then do me a favor, hit the like button and subscribe to the channel if you're not already. Also, head over to MeaningfulAcademy.com and check out the course there called Build Wealth. In that course, I go into much more detail about investing and planning and organizing your financial life. Check it out, and if you think it's for you, use the coupon code YouTube to get a decent discount. Cheers. Right, back to that point about share prices rising and falling, and the value of our investments rising and falling too. Sounds a bit scary, doesn't it? Well, it can be, and that is the reason why far too many people don't get the kind of returns I was talking about last time. Come back to that later. This is an actual performance chart for an actual portfolio that I have built for clients at my firm. If you're interested, it's invested 80% in world shares and 20% in global bonds. And it assumes an annual charge of 1% on top of the fund charges. Now, if you're a DIY investor, that is, you're not paying an advisor like me, you should be paying much less than that in costs. The chart covers just over 11 years because that's when this investment started, but really you can pick any long-term time frame. And you can see that this is definitely not a straight line, right? It's very jaggedy. And there are three obvious difficult periods. This one is the challenging summer of 2015. China decided to devalue its currency and the rest of the world panicked. And the total fall in the value of the portfolio in that period was about 13.5% down. This is the COVID pandemic reaction. Portfolio fell in value by about 22.5%, nearly a quarter of your value gone, but you can see it did recover pretty quickly. And then this is early 2022, the beginning of the high inflation, rising interest rates period, triggered by, among other things, Putin going into Ukraine, fallout from the pandemic, and a whole bunch of other factors. That is about another 13.5% fall, and actually it hasn't quite recovered yet, 2 years on. But despite these pretty unpleasant periods, the portfolio has still delivered a return of just shy of 125% in 11 years. That is a simple annual average return of 11.4% per year. If you'd invested £1,000 at the start of this chart and just left it and done nothing, you'd have 2,225 quid at the end of it. Now, inflation over that period has averaged about 2.9%, which means your original £1,000 would have to have grown to £1,369 to buy the same things. Well, you've actually got 2,225, so you've made nearly 900 quid in profit in real terms. But most of you watching this just won't get those kinds of returns. And here's why. Actually, there are a few reasons, and one really big one. And when you blend them all together, you get a hugely reduced outcome. The first reason is costs. I allowed for 1% per year of costs, plus the fund charges, in the chart that I showed you earlier. Now, if I double that and allow for a 2% charge, then you would have given up 1/5 of your return over that 11-year period. So instead of £2,225 at the end, you'd have had just over £2,000. As investors, we have to watch our costs. It's one of the very few things we can control. And this goes for tax too. We should use pensions and ISAs so that our money isn't taxed as it grows and is held back that way. What you invest in is important, of course it is. If you built a portfolio of UK gilts over the same period, you'd have made next to no money at all in 11 years. So what you buy matters. And the growth in any portfolio primarily comes from shares. It's the great companies of the world. Lots of people hold bonds to kind of temper the volatility of shares, but if you hold too high a proportion of bonds, it will be a drag on your returns. So costs, tax, asset allocation, how you spread your money around. Those bring us to the biggest factor, which is many people just can't handle the volatility of the stock market. It's a fact. They watch their portfolio fall in value by 20, 30, 40, maybe even 50% in tough times. And they bail out because they just can't handle it anymore. And I get it, right? Watching your hard-earned money fall in value is hard. It's very tempting to just throw up your hands and say, enough is enough, I'm out. But that is the point at which you do the most damage, because most people leave it far too late to go back in, if they go back in at all. They wait until things fall too far for their liking, and then they bail out, and then they watch as things recover, saying things like, well, I'll go back in when things settle down. And they miss out on all the upside that inevitably follows a bad fall. Look at every market decline in history. It always comes back up again. Yes, it does sometimes take longer than others. You might have to wait years for your fund value to recover, but it will always happen. Always has done in the past. I see no reason why it shouldn't in the future. It's far better to ride the whole roller coaster journey, and even better to keep investing and adding new money throughout the difficult times, because while markets are down, you're buying stocks on the cheap. So I hope that answers the question about returns being possible. When I use a 6% average return, it is based on historical experience. I'm not plucking these figures out of the air, I promise. But I'm not talking about interest, I'm talking about returns. And I am assuming that you are an investor who understands that markets and investments rise and fall, and that you have the guts to ride them up and down because you know that in the long term, a broadly diversified, low-cost, tax-efficient, high-equity portfolio will rise. Can't wait for the comments on this one. Should be fun. Do like the video and subscribe to the channel if you're not already, because there's loads more where this came from. And while you're waiting for the next video, maybe check this one out about how pensions work in the UK. Pensions are so misunderstood, and yet they are the most important account that any of us will ever have. Thanks for watching this one. I'll see you next time.